So the credit markets are important for many reasons, mainly because companies, public companies in particular, but also small businesses, borrow money to fund their day-to-day operations. And if there's a short-term blip in credit markets where credit, which is really, that's just a word for borrowing money. If you're unable to borrow money from either your bank or if you're a public company from the markets, if you're unable to do that quickly and easily or at a reasonable price relative to whatever it would have cost you yesterday, there can be a major hiccup in your operations because, let's say I borrow money to meet my payroll, which is okay if the money that you're taking in is regular. If you can count on your accounts receivable, then it's okay to just borrow money for your daily needs. If those markets seize up and you're unable to access credit that you were a day or a week or a month ago, that can really throw a wrench into things for every single company in existence. And that's why we started to see things, prices started to dislocate, not just in stocks, but in bonds. And I think that's when people started to get really scared, is when you saw large ETFs for high yield and high quality corporate bonds start to sell off by 15-20% in the second, third week of March. That was really scary, because if bonds are selling off as steeply as stocks are, then that just shows that there's major uncertainty in the credit markets. And like I said, if large businesses can't borrow quickly and cheaply to fund their operations, then we're back to a 2008 scenario. The Fed went in and they said, okay, well, we're going to start providing liquidity in not just the Treasury market, but also high quality corporate bonds, short-term municipal bonds, and even high yield bonds. That was unprecedented, and that very quickly restored confidence to credit markets. And then you saw it, it really did not take long for that confidence to come back into the stock market. And nothing has really gotten better from a health standpoint and virus headlines. I know that the curve has started to flatten and we're getting better reports of new daily cases, new daily deaths. All of that stuff has started to feel better. And they're talking about an end to the shutdown or a coordinated reopening of parts of the economy. But the economy is no more open or healthier than it was 3 weeks ago when the stock market was cratering. It makes perfect sense that you should buy what the Fed is buying, because the Fed has more money than whoever is selling anything. The big moves, I think, have already happened, most likely, with high yield bonds and corporate bonds. I mean, you saw LQD, which is one of the largest, if not the largest, index fund for high quality corporate bonds. You saw it drop from 130 to 105 in March, and then it's snapped back almost back to where it was. So to argue that we should be buying it now, I think it's too late. You missed it. That would have been a great trade or investment if you were initiating a position in the third week of March, because bonds are safer than stocks and the Fed has your back. There's almost no way to lose money had you bought LQD at the lows. The short answer, can the Fed buy equities or the S&P 500 buy futures? The short answer is, why not? A month ago, nobody would have said yes to the answer, can the Fed buy high yield bonds or municipal bonds or corporate bonds? They've found a way to do that. If things get extreme enough, I think the takeaway from what's happened in the last month is that the Federal Reserve has unlimited financial authority to assist in the capital markets. So people who were bearish in early March were correct or lucky, depending on your view. But to stay bearish after what the Fed has just unleashed is, I don't want to say misguided, because there's always potential downside in stocks. Stocks are a risky asset class. But to stay bearish for the same reasons you were bearish in early March, I don't think that makes sense. The high yield spread is what people look at as a signal of distress in the high yield space. So, and we're going to show a graphic that demonstrates what has happened with previous recessions, specific to the high yield spread blowing out. What that means to the everyday person is that your cost of borrowing just skyrockets for all intents and purposes overnight. And that it can literally force companies into bankruptcy very, very quickly. So what the Fed did last month is they offered a little bit of a rescue package to the high yield market. The reason that the front month contract for oil is negative today, and it seems like complete insanity. You have to pay somebody to take oil off your hands for the month of May. The reason for that is there's no more storage left, or at least there's virtually no more storage left. There's no places to keep oil. So we have so much of it, and storage is already all occupied, whether that's in the tanks that we've got here on land, or people are using tankers, ships in the middle of the ocean that just store oil. They're just sitting there full of oil. I think what's being priced in is that it can't get much worse for the oil market. The fact that there's no place to put it implies that producers are going to have to stop making the stuff. They're going to have to stop shipping it, and they're going to force shut-ins, which means companies are going to have to stop drilling for oil and sending it places. The message that we're seeing in today's market is most energy stocks, or the higher quality ones, the Chevrons and the Exxons, you're seeing them down a little bit today, but they're nowhere near as low as they were a month ago. So despite that you're seeing headlines that oil is negative, these companies that their business is to sell oil, their stocks are in a better place now than they were a month ago. I think the market is starting to digest that. We've got a little bit of a painful period. There's going to be some energy companies that you've never heard of that go out of business and default on their debts. But the companies that are in better shape they're in better shape, and they're going to be okay. And I think the market is starting to digest that things are about to get better for the energy companies who survive this. What could go right is, maybe regardless of what happens with the virus trajectory, maybe we get some further good news from these drug companies that are seeming to have good luck with drugs. Gilead with remdesivir seems to be having some positive effects on patients. I can't speak really intelligently about that specifically, but seemed to be some good news late last week about that. And that's just one example. There's other drug companies working on similar type treatments, not vaccines, but treatments. A vaccine would obviously be incredibly bullish, because people would just no longer worry about the disease at all. So that's one thing that could go right from a health standpoint. And then as far as stimulus, we could they could increase the size of the stimulus package. They could find a way to get it to the small businesses and people who need it the most. In larger scale, maybe they increase the number of months that people are going to get this help. That's something that could go right. And also, something that hasn't really been touched on yet is that the stock market has started to recover a little bit. That on its own can provide some confidence to the market. It sounds a little counterintuitive, but the market falling apart for 3 straight weeks in early March created more fear around the virus, in my opinion. Those are my words, but I believe it to be true, and I think the market recovering for the last 3 weeks can have the exact opposite effect. People can start to wonder, well, maybe things aren't quite as bad as it felt last month. And that sort of thing can have a positive impact on confidence for both consumers and businesses. So a lot still can go right.